And so a cost segregation study comes in and identifies those short-term assets, puts a value to them that then allows you and your tax preparer to depreciate those over a faster rate. So again, think about it. Again, I buy this building. Instead of taking 1/27th, I break it up into 5, 7, and 15-year buckets. I'll call them buckets. I don't know that that's the technical term. They're really asset classes.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today's guest holds a Bachelor's of Applied Science in Accounting, but I think the really important piece of where his journey, where his stack of experiences has led him is in the real estate world. He is a real estate investor. He's blood, sweat, and tears, has learned what he wants to do, what he doesn't want to do. And today we get to talk about some very unique investment opportunities, strategies. One of the things that was new for me was the micro apartments and the capital gain funds in opportunity zone funds. Just really interesting stuff. But the big piece of the pie here is cost segregation. What is it? How do we use it? What's it good for? How can I learn more about it? It's just a great way to really take as much as we can from the given code, the tax law that's out there regarding cost segregation and the big one, bonus depreciation. If you're wondering where that's at this year, where it's going to be next year, we're going to talk a little bit about that. And today's guest is Mr. Erik Oliver. Please welcome him to the show. Mr. Erik Oliver coming to us from Mountain Time today, and I'm excited when we get into these types of conversations directly related to tax savings and how that relates to us real estate investors here in the Real Estate Mogul. Mr. Erik Oliver, welcome to the show.
Thanks, Brett. Thanks for having me. I'm glad to be here.
Awesome. And we were just chatting here before, we're talking about the weather, and the last guest I had on is talking about the weather. I'm kind of shivering down here in the Carolinas. It's hitting the 50s. But no, you're seeing snow out there, right?
Yeah. The mountains got their first dusting here over the last week. So I personally am excited for the snow. I run hot naturally, so I can't do the heat. So I'm excited for the cooler weather.
That's fun. And so we are here in the beginning of November recording this episode. And, you know, I love the snow, and I think of it the same way. I grew up in Michigan, and, you know, there's like 2 months out of the year it's just absolutely gorgeous. And the rest of the time it's not so much for me, in my opinion, but the snow I see the same way as New York City. Now, there may be some listeners out there who may shame me for this, but I love New York City. I love going to New York City. I love the snow. I love going to places that have the snow, but I also love coming home after that. So I love going, and then I love being able to leave. But either way, here we are. You're out there. I have some very close colleagues of mine who are also out there, I think in Park City area. In the financial consulting world and in the tax world as well. So let's get into this, Erik. Let's talk a little bit about your path leading you into where you're at, because you're not a physician. I'm not a physician, but here we are in Real Estate Mogul MD, sharing our experience, our knowledge, and kind of our abilities with the physicians who are able to take advantage of this, right? So you're with a company called Cost Segregation Authority. How did that come about? I mean, you don't go to school for cost seg, right? So tell us a little bit about your path to this point, Erik.
That's a great question. I've got a 16-year-old son. I always ask him, you know, what do you want to do? He's like, Dad, when you were my age, did you say that you wanted to be a cost segregation consultant? I'm like, no, I guess not. I guess you're right. He's like, well, I have no clue what I want to do. And kind of the same went for me. So my background, my degree was in accounting, not by choice necessarily, but I wanted to get out of college as quickly as I could. I hated science. I can't write a paper to save my life, but numbers always came somewhat easy. So I'm like, okay, what's the quickest, fastest way, easiest way for me to get out of this college stuff? And it was either finance or accounting. So I went into accounting, never really used my degree. Right out of college, I went into sales, business development. That took me to the East Coast, lived in Virginia for about 12 years. and then moved to Long Island, New York for about 5. Was looking to come back to Salt Lake. My parents were getting older. I had had kids over those course of time in New York and Virginia. Wanted to get them back here with their grandparents and stuff. And so started looking for jobs. I actually came across this job. It required some accounting background as well as some sales experience. And so I did not know what cost segregation was, like most of us. I had to look it up before I did my job interview. And that was 7 years ago. Fast forward to today. I've loved this job. It's gotten me into real estate. I've always been interested in real estate. Being at this company, attending different conferences, speaking at different conferences, both regionally and nationally, it's really I've made some great contacts to be able to invest in real estate myself. Love trying to save people tax money. It's kind of a different way of looking at investing. A lot of us look at like, how can I add more doors? How can I add more revenue to my real estate portfolio? But this is kind of I use the sport analogy. This is the defense versus the offense. A lot of us focus on how we can score more points, but it doesn't matter if you score 100 points. If your defense gives up 101 points, you still lose the game. And so, the classic saying, it's not what you make, it's what you keep. And being able to help save money on the backside in terms of taxes is really where I found my niche. I love what I do and love helping people save money on taxes. So that's kind of how I got here.
Very interesting. And having those conversations with your children, what do you want to do when you grow up? I don't know. And then what happens, Eric, when they come back and say, man, I just want to get out of school as fast as possible? How does that make you feel? Oh, no, that didn't fall far from the tree, right?
Right.
Very fun. But yeah, in seriousness, though, the idea of it's not all about what you make, it's about what you keep. And a close mentor of mine always made mention of that to me. It's like, any business can make a ton of money, but how much money can a business keep? And that's always fascinates me when I see people ranting on about revenue and revenue and revenue. And it's like, what does that mean? It doesn't mean anything, right? Because if I make $1 million, but it cost me $1.2 million to make $1 million, then I didn't have anything, right? So Getting down to the money that we keep in our pocket, and it's very interesting how now you've made your way into this cost segregation platform. I'm excited to dive right down into that. But a little bit before that, tell us a little bit about your real estate investing journey.
Sure. So when I was in Virginia, we had 2 kids at the time. We decided to move to New York. My wife was born and raised in Long Island, New York. And so we moved to New York, and we had our primary house, and we said, well, let's turn this into a rental. We're going to move to New York. It was my first rental property. I thought I knew everything. I'm like, I'm not getting a property management group. I can screen these people. And long story short, it was an absolute disaster. So we moved to New York and got some renters in there. I screened them. I thought they were great people. Turns out they were not willing to pay their rent. Then I couldn't.
They worked you over.
They worked me over. They knew exactly what they were doing. And that's why they chose me versus somebody else who ran a background check and did it the right way. I sat and met with them at my kitchen table. They seemed like nice people, and they knew exactly what they were doing. They paid their rent the first 2 months. Once they started getting their wages garnished from the previous place they had lived, then they stopped paying my rent. And so because I was in another state, I couldn't just go knock on the door and get them out of there. And so we had to go through the whole eviction process. Learned a big lesson there that I can't be good at everything, right? Like, I know what I'm good at, and property management and screening people is not something I'm good at. And so as I continue to build my portfolio, I've got some short-term rentals now. I'm also invested in some micro apartments here locally. And so as part of an opportunity zone fund, I've invested some of my retirement accounts into those opportunity zone micro apartments. And so that's kind of where I'm at now. Learned a lot of lessons along the way. Like I said, biggest lesson being I can't be an expert at everything. You got to build your team, surround yourself with people who, you need a marketing person, you need a great real estate agent, you need a great architect, you need great property management folks, and you can't be an expert at everything. So know what you're good at and then build your team around you is kind of the lesson I've learned.
And taxes is definitely one of those things that I know my limits, but I'm also excited about just having enough knowledge to plant the seed, right? To ask the right questions, right? To believe the right person, to bring the right person to the table to ask the right question, to just like you're saying, building your team. Before we jump into a couple of things I definitely want to talk about is bonus depreciation. Here we are in the end of 2022. What's happened in 2023? And then also this recapture idea. If we accelerate the depreciation, what happens when we do sell these properties? But before we get there, I wanted to kind of unpack a little bit what you were saying about micro apartments, because I've never heard that term before. Erik, what is micro apartments?
Yeah, so these are smaller apartments. They're anywhere from like 400 square feet to 600 square feet, built near transportation hubs. So they usually don't have parking lots. So if you're driving a car, it's not a great option for you. But there's one here in downtown Salt Lake that's right on we call it tracks here. That's our public transit system, right on a tracks route, right next to the stop. And so we get a ton of students, faculty from the local university. It's lower cost to get into one of these micro apartments. They're usually studio apartments with a small kitchenette. But the idea is we build these from the ground up, and then we stabilize them, get people in there, and then we turn around and sell them, and we just keep rolling the money from one opportunity fund to the next. And then the hope is here in 10 years with the rules of the opportunity zone funds, we don't have to pay tax on any of that capital gain. And so that's a great way for any of you doctors out there that have large capital gains. Definitely something to look into is opportunity zone funds. You can either create these funds yourself. It requires a lot of work, but most of us just invest passively into other folks' funds. So there's a lot of fund operators out there who are building these projects and they're looking for money, and you can park your capital gains there. And if you keep that investment in that fund for 10 years or more, when you pull that capital gains out, or that capital gain out, when you sell the asset, you pay no tax on the appreciation of that gain. And so it's a great opportunity. It has to be capital gain funds. You have to invest in capital gains. But if you're selling your practice or you're selling real estate and you've got that big capital gain and you don't need to access the money for the next 10 years, it's a great opportunity to invest in some of these projects.
Very interesting. So there's a lot of really interesting stuff that you just talked about right there. But the capital itself has to be from almost like an exchange from a capital gains to go into these funds.
Right. Yeah. You can't take current cash flow you have. You can't take cash and invest in these funds and expect to not pay tax on those gains. The whole idea behind this, the government uses these programs to incentivize people to do certain actions. So they want you to take, like if I was a doctor and I sold my practice, instead of parking that money in a bank account, earning, 2% interest at most, why not reinvest that into the community? So these opportunity zone funds, they are in what the IRS has determined to be low income areas. So it's based off census data. Each state had to put together these certain zones. And so the idea is to get people to reinvest their capital into areas that need to have capital. So like I said, low income areas, you reinvest it in these areas, you build something up, and then you sell it, and you don't have to pay tax on that gain as long as you're using your capital gains to invest in these areas. That's the key.
It's almost like 1031 exchange. When I sell one investment property and I can roll it into another like investment property, but this is for the capital gains off of a different investment you can put into these opportunity zone funds. Really, really interesting there. And then you also mentioned using your retirement funds to invest in real estate. What all? First of all, you're not a CPA, correct? Are you a certified public accountant?
No, I am not a CPA. Okay. Yeah, my degree's in accounting, but definitely not a CPA.
Right. So we're more on the lines of consulting or just big ideas. So in that path, I love sharing my personal experience as well, too. And just wanted to share your personal experience with retirement funds and investing in real estate. What does that look like for you?
Yeah. So I had for my previous job, I had been there almost 15 years at my previous job, had a decent size 401k, and it was just sitting in that 401k. And I felt like with some of the returns I've seen, I got into these opportunity zones, these micro apartments with the founder of our company here at Cost Segregation Authority. And I saw some of the returns. I said, hey, those are way better returns than what I'm getting on my 401k. is there an opportunity for me to invest? And he said yes. And so what I did was I put those into an IRA. I took those out of my 401k, put them into an IRA, invested those through my IRA into those micro apartments. Now, the drawback of doing that, obviously, when we sell that asset, that money has to go back into my IRA, and I can't access that money till I think it's 65, 64, whatever the retirement age is for an IRA. So otherwise, there's penalties. So it's no different than any other retirement account, whether you were investing in stocks. If you invest in stocks through your 401k, the return on those stocks goes back into that 401k, and you can't access that money until you're a certain age. It's the same thing with an IRA. And so that's where I was able to pull it out, put it in an IRA. And as long as I was investing and putting that money back into that account, I don't have to pay any penalties or tax or anything like that. So that's how I was able to do it.
So I'm hearing you basically explaining a self-directed IRA.
Yep.
You rolled your 401k into a standard IRA, and then you made that a self-directed account. Love it. Love it. Exactly. I actually do that with the Roth IRA. My Roth IRA is self-directed.
Okay.
So same way, same stipulations. There are additional stipulations with the investments. Again, I'm not a CPA. This is my own personal experience. But when I use my Roth IRA for investments, there are certain things that I can't do. Like I can't go, if I owned an apartment building, I can't go swim in the pool, or I can't stay in the property, right? So there's certain things I can't do. But I love it because in my Roth IRA, Eric, I have money that's already been taxed. Yep. So now when I'm investing this, all of my gains will not be taxed, given the current legislation. All the laws stay the same with which they are right now, but they don't, and they won't. Maybe they will, but we just have to stay ahead of these things and leverage the things that the government gives us to help produce what they want us to produce. And as real estate investors, one of these things that's changing right now, Eric, is the bonus depreciation and how we're now stepping away from that. So I'm excited to talk about Cost Seg. And Cost Seg is basically a version, right? It produces bonus or accelerated depreciation. Is that correct?
Yeah. So bonus and cost segregation are separate, but bonus puts cost segregation on steroids. So kind of how it works is normally when you buy a piece of real estate, if it's a commercial building, it gets depreciated over 39 years. Residential units, like a single family home or an apartment building, they get depreciated over 27 and a half years. So that's called straight line depreciation. You take your purchase price, you minus the land, because land is never depreciable. So you take your purchase price minus land, that gives you what we call your depreciable basis. Then you take that depreciable basis, and if it were an apartment building, for example, you would divide that depreciable basis by 27 and a half years. So you're getting, and that creates a depreciation expense. Now that expense comes off your taxable income. So that's great. That's why a lot of us invest in real estate, is because every year we get this depreciation deduction that we don't have to pay tax on. Now, that's great, but I'm not going to necessarily own my property for 27 and a half years. I want more deductions faster and quicker and bigger deductions. And so the way you do that is through an engineering-based study where we come in and say, okay, well, yeah, you bought an apartment building, but according to the IRS says that carpet doesn't last 27 and a half years, and carpet should actually be depreciated over 5 years. And so a cost segregation study comes in and identifies those short-term assets, puts a value to them that then allows you and your tax preparer to depreciate those over a faster rate. So again, think about it. Again, I buy this building. Instead of taking 1/27th, I break it up into 5, 7, and 15-year buckets. I'll call them buckets. I don't know that that's the technical term. They're really asset classes.
I like buckets.
Buckets makes it sound easier. So the 5-year bucket is all the inside stuff of your apartment building. So the flooring, the cabinets, the countertops, the ceiling fans, garbage disposals, appliances, that all gets categorized as 5-year assets. There's usually not a lot of 7-year assets. That's kind of your telecommunication lines, if you got cable lines, whatnot. And then the next big category is your 15-year assets. This is all the curbs, gutters, asphalt, land improvements, landscaping, irrigation, fencing, signage, all that exterior stuff of your building. And so by segregating that and putting it into those buckets, we now get to depreciate our 5-year assets over 5 years. Now, the reason, but your CPA doesn't do this naturally, is when you buy a building, you hand them the closing statement that says, hey, I bought this apartment building for $1 million. Your tax preparer has no clue what the value of the parking lot is. They don't know if it's 4-inch asphalt or 6-inch asphalt, nor should they know that. So what they do is they just put it all on as one big lump sum and depreciate it over 27 and a half years. But a cost seg study identifies those assets, puts a value to them, and says, hey, the parking lot is worth $80,000. So now your CPA can take that $80,000 and depreciate it over 15 years versus 27 and a half. So that's cost segregation 101. Just as the name implies, we're segregating the costs of the building. Now let's throw bonus depreciation on top of that. And bonus depreciation takes those 5-year assets and gives them an additional bump in terms of what you can depreciate. So currently, the bonus depreciation law for 2023 is at 80%. And what that means is that any asset life or any asset class that has a useful life of 20 years or less, you get to take an 80% bump in the first year. So we're going to make the math real easy here. Let's say we buy $1 million building, we do a cost seg study, and the cost seg firm identifies $100,000 worth of 5-year assets. And I'm going to oversimplify this a little bit just for simplicity, but normally that 100,000 would have to be divided up over 5 years. When you apply bonus to that, 80% bonus, that means that you get to take 80% of that 100,000 or 80,000 all as a deduction in the first year. The remaining 20% spreads out over the next 4 years of the useful life of those 5-year assets. And so you can see that bonus depreciation just puts cost segregation on steroids because it says, hey, we're going to give you an 80% bump in year one, and then the other 20% will spread out over the next useful life of that asset. So long story short, Brett, if you've got real estate and you're paying taxes, definitely look into cost segregation because with this bonus depreciation, there's huge deductions that are available to investors out there by utilizing some of those shorter asset life categories.
We're talking about buckets. First of all, thank you for that explanation there. That is awesome. So bonus versus the cost seg, and then the cost seg idea, the 101 on that was amazing. It helps me understand this. The bonus versus passive and active income. So what happens, say we take this 80,000 value. So we get to mark down our adjusted gross income, $80,000, right? It's not directly $80,000 savings. We use our effective tax bracket, get into some accounting things there to figure out the action, but this is real money stays in our pocket. Sure. We're talking about buckets. I can only use passive losses to offset my passive income unless I have a real estate professional qualification. So what happens if I'm able to bonus depreciate this $80,000, but I don't have that much in passive income? What happens to the rest of that depreciation?
No, that's a great point that sometimes gets overlooked. You hit it on the head. These deductions we're creating through cost segregation are typically considered passive, as you mentioned. So if I'm a doctor at the hospital and I get a W-2 income from the hospital, my deductions from my real estate cannot be used to offset my high W-2 income unless I'm a real estate professional or I'm married to a real estate professional and we file a joint tax return. So let me just unpack that for a second. To become a real estate professional, you need 750 hours of real estate activity a year. That's about 14 and a half hours a week. That's the easy test. Some of you may spend that, even though you're working at the hospital full-time or you're being a doctor full-time, you might actually spend 14 hours on your real estate portfolio. That's the easy test. The harder test to pass to be a real estate professional for tax purposes is you have to spend 51% of your working time doing real estate. Meaning, if I'm doing 40 hours a week at the hospital, the IRS is going to say you have to do 41 hours a week as a real estate person or real estate professional. That's the harder test. The IRS is never going to believe that you're doing 40 hours at the hospital and 41 on your real estate. And so a lot of times high W-2 earners or doctors in that example, if they have a stay-at-home spouse, maybe they can have their stay-at-home spouse qualify as the real estate professional. So they can manage their portfolio. They can get in the 14 hours a week, do the 51% of their working time. If you file a joint tax return, then all of a sudden those real estate deductions can be used to offset your high W-2 income. So that's just one thing you always want to look at. If you can qualify as a real estate professional, that's kind of the golden ticket in the real estate world in terms of being able to save huge amounts of money on your taxes. That's the first thing. The second thing that you brought up is, hey, maybe I can't, maybe I'm not married. Maybe my spouse doesn't want to manage my properties, and so I don't qualify. How can I utilize those deductions? There's a couple ways. One is, if you were to sell any real estate. So the first thing is, when I create this deduction, let's say I create or in this example, we used $80,000 of depreciable or depreciation. If I only have $20,000 of passive income, I'm going to wipe out that 20,000, and then I'm going to have 60,000 that gets carried forward into the next year. So when I make 20,000 next year, I'm going to wipe that out, make 27,000 or 20,000 next year. I keep wiping that out until that 80,000 is all utilized. That's the one way. So you never lose the deduction. It just carries forward and it wipes out the passive income going forward. The second way is if you sell an asset. So if you have a piece of real estate and you sell it and it creates a gain, and you've got this gain sitting here in this deduction, this depreciation expense sitting in this bucket that can't be utilized. If I sell an asset and have an $80,000 gain, all of a sudden that unlocks this $80,000 depreciation expense and offsets that gain. So cost segregation is a great tool to use if you're selling any real estate assets and you're going to have a gain. That's the other way you can use it. And then the third way, there's something called a short-term loophole. Maybe you guys have heard about that. It's pretty popular now, but it's a great way. Short-term or kind of your Airbnb vacation home type properties, if you invest in those as a W-2 earner, those get treated a little bit differently than a long-term rental. So think about an Airbnb. An Airbnb is more like a hotel. And so the IRS says, hey, if the average stay at your Airbnb is 7 days or less, and you materially participate in the management of that property, and there's 7 different tests, you only have to qualify for one to show material participation. If you can materially participate in the management of those properties, then we're going to allow you to use those deductions. Basically, you're saying, hey, I'm a doctor, but on the side, I run this hotel business. And so because you're running a business, they allow you to use those deductions from your Airbnb to offset not only your Airbnb income, but also your active W-2 income. So a lot of high W-2 earners will invest in short-term rentals, use those deductions to offset their doctor income and pay less tax. And so that's a great way to listen. You're going to pay that money anyways. I'll give you a real life example here, Brett, because I'm a W-2 employee and my wife is in the school district. So at the end of 2022, I had made decent money in 2022, and I was going to owe about $80,000 in taxes come April of 2023. And so at the end of 22, I bought a short-term rental at a nearby lake here near Salt Lake. And I was able to do a cost seg study on that property. I was able to get back about $60,000 out of my $80,000 down payment in terms of tax savings. Had I not done that, I would have just paid that $80,000 to the government and never seen the money again. Instead, I basically used that $80,000 as a down payment on my property, got $60,000 of that back, and was able to now have a revenue generating short-term rental at a nearby lake here to Salt Lake. And so being strategic about the type of assets that you're investing in is helpful. Some people need deductions. Some people want growth, or they want capital, they want equity in these properties. And so depending on what your goals are might dictate on what type of property you may invest in. But that's just an example of how I was able to utilize. I was going to have to pay that $80,000 out at the end of the year either way. Instead, I put that towards a revenue generating property and then got a huge tax return by doing so. So it was a wash.
If there's, I smiled several times in all 3 of those points that you were talking about. They are exciting. Is there a general, I guess, proportion or ratio that you could kind of figure? Say if I buy $100,000 house, what could I roughly shoot for in a bonus, 80% bonus type scenario in that first year?
Sure. So that's a great question. So we can do some quick kind of back of the napkin type math. So let's use $1 million. Let's say you buy $1 million asset. Well, let's say you buy $1.2 million. So we're going to buy $1.2 million worth of asset. We're going to say the land is worth $200,000. So we're just going to get rid of that. That gives us $1 million of depreciable basis.
Is that land? Sorry to interrupt you, Eric. Is that land, that value is just the assessed value of the land?
That's a great question. It's kind of a gray area. There's a number of ways to determine land value. One is through the county assessor. Some tax preparers still use an old 80-20 rule where they say 80% of it is building, 20% of it is land. There's comps, but yeah, the assessor is probably the safest tool. So look at the county assessor. Let's say that in our example, we bought it for 1.2. The county is saying, hey, the land is worth 200,000. That gives us $1 million of depreciable basis. We do a cost seg study on that. A cost seg study on average will segregate around 30% into shorter asset lives. So of that $1 million, we're going to come in and say, okay, 300,000 of that was for things like flooring, garbage disposals, appliances, fencing, etc. So now we've got 300,000 that we've segregated, and then you're going to get 80% of that 300,000 in the first year. So in that example, you buy $1 million property, you're going to get 80% of 300,000, which is 240,000 as a write-off in the first year. Now take that $240,000 write-off. If you're in a 30% tax bracket, that's a $72,000 tax savings. So on that's
real money.
That's real money.
Real money.
So I let's say maybe I had to put 20% down on this property. So I paid $200,000 for this property, did a cost seg study, and then saved $72,000 in taxes. And so my net down is, $124,000, et cetera, essentially.
So in this, you say we acquired it for 1.2. A lot of us investors are looking for value add scenarios. So we're going to basically have a purchase price and then actual expenditures for improvements. So does that depreciable value, is that both the acquisition and the renovations?
It depends. So definitely the acquisition, as long as that acquisition was placed in service. So if you buy a vacant building that's all beat up, and then you got to put $500,000 into fixing it up, your total depreciable basis is now $1.5 million, and you would just do the cost seg study once you finish the renovations.
Yeah.
If you buy an existing building that's already got a lease on it, people are renting it out, you would do a cost seg study on that original purchase, and then your improvements, some of those improvements you would be able to expense as repairs and maintenance. And there's some different rules around that. There's some safe harbors. If it's under $2,500, et cetera, you can just write it off. So those just become immediate write-offs. Anything of that improvement cost that needs to be capitalized, you could do a cost seg study on that and then utilize those deductions as well. So you're kind of getting a 2-for-1 in that scenario where I buy the original building. I'm going to cost segregate, take deductions on the original flooring. Then I'm going to go put new flooring in, and now I get to take the deductions on the new flooring as well. So, but yes, you can actually take deductions or expense some of those improvements, and that's just additional deductions against your income.
And that $2,500, is that for the entire year or for each project?
No, that's for each component. So if I put in, it's just like the IRS basically says, listen, if you've got a rental property and you go put in a $1,500 refrigerator, we're not going to make you do all the paperwork and the bookkeeping on that $1,500 refrigerator. We're just going to let you expense that. So it just acts as an expense, comes right off of your income. You pay no taxes on that portion of it. So any single component of the building that you're replacing, if you go in and you put a new toilet in, the IRS isn't going to make you depreciate that toilet over 27 and a half years because the bookkeeping isn't worth the deduction, right? So they're saying, hey, all the small stuff, we're just going to let you write that off as an expense. Anything over $2,500, we're going to make you either capitalize it and depreciate it over its useful life, or there's certain things that you can even expense over $2,500 if it's normal repairs and maintenance. And there's all kinds of IRS regulations on what qualifies as repairs and maintenance. But the idea is anything under $2,500 can typically just be written off as an expense.
I really like that idea. And in my mind, I'm thinking of all the projects that we could hit before the end of year. The one thing you did mention there, which is really big, is putting a asset into service or a building into service, which means I basically have to put it up for rent. I have to lease it. And that's when it is in service. So if I buy, Eric, say, hey, we're going to buy this apartment building and it's vacant and we're going to not going to rent it, here in the end of 2023, we're not going to rent it till halfway through 2024. I don't get anything from it this year in regards to depreciation, correct?
Correct. Yep. It's all your depreciation starts on the in-service date. And so it's important to make sure that building gets in service. So in that scenario, if you needed the deductions for 2023 and you bought it at the end of the year, you would want to get some renters in there. Even if it's just in a couple of the units, get some renters in there, start renovating the other units so that you can qualify it as in service for 2023. So that way you can take the deductions. But you're absolutely correct.
Very interesting. And now this idea of that 80%, I just want to touch on this just a little bit. I heard you say it this way, that it's sunsetting. So it used to be 100%, right? It used to be 100%. Now we're 80%. Now we're stepping down. And this is the same way for, I believe it's Section 179 as well. Like when we can qualify certain vehicles over 6,000 gross vehicle weight, 6,000 pounds gross vehicle weight, to accelerate this depreciation, capturing this bonus depreciation. So where are we headed with this? Because I've got a couple properties this year that I want to go ahead and trigger the cost seg on, because I don't know what's going to happen next year. What's going to happen the year after that?
Sure. So you're absolutely right. So bonus depreciation, the government uses bonus depreciation to stimulate the economy. So it was actually with the Tax Cuts and Jobs Act. Donald Trump was our president. Donald Trump owns a boatload of real estate. And so he increased it it was 50%. He increased it to 100%. So kind of the phase out period is any assets placed into service between 9/27 of 17 and 12/31 of 2022 received 100% bonus. So that was everything prior to this year. Starting this year, it dropped to 80%. Next year, it drops to 60%. The following year is 40, then 20, then 0. So in 2027, it'll actually be 0. Now, it's important to remember this is based off the in-service date. So if I buy a property this year, 2023, don't do the cost seg study till 2025, I still get the 80% bonus because I bought the property and placed it into service. So it's not based on the year you do the cost seg study. It's based on the year you put it into service. So that's the first thing. The second thing is there are talks. There's been, I believe, 2 proposals put forth by the Ways and Means Committee in Congress to extend the 100% bonus through 2025. So Congress will get together here in the fall. Hopefully they'll extend the 100% bonus. Again, they use it to stimulate the economy. So if the economy is not doing well, which it's not doing great right now, they can utilize this 100% bonus to incentivize people to go out and buy stuff. So there is a chance that bonus depreciation at 100% could be extended through 2025. So remember, we don't have to file our taxes till next April. So by next April, they'll let us know if we were able to take 80% on the assets for 2023 or if we're able to take 100%. But that's just something to keep an eye on. Hopefully they do extend it. I do think they will extend it personally, but we'll have to wait and see.
In service date, not when you do the cost seg. Very, very valuable information there. Now, with this bonus depreciation, and I've heard it, called kicking the can down the road. So in real estate, I like the idea, and I've heard a colleague of mine say this before. It was depreciate, exchange, depreciate, die. So I'm kicking this can down the road again and again and again, and I'm using these, I guess, strategies that the government gives us, similar to the cost segregation, but the 1031 exchange, to basically roll this depreciation down the road further and further with these specialized strategies, and never have to recapture this depreciation. Right? Is that what the way you would explain it too?
Yeah. So 1031 is so anytime you 1031 exchange, it allows you to kick your gains and your depreciation recapture. It allows you to defer that. And then, like you said, you 1031 exchange, 1031 exchange, 1031 exchange. Unfortunately, we all die at some point. When we die, our estate will get a step up in basis to fair market value, and no one pays tax on that asset. And so that's the first thing, is just exchange. Unfortunately, we die, no one pays tax. The second thing is on the depreciation recapture side. So a lot of tax preparers, this is a question we get asked quite often, is, Erik, if I take all this depreciation up front, that just means if and when I sell, I'm going to have a bigger capital gains tax. And the answer is yes and no. The answer is really no, because let me explain. I'll kind of back into this example because I think it makes more sense. When you sell your asset, so when you buy a building and you sell it, you pay two types of tax. You pay capital gains tax, and you pay depreciation recapture tax on the depreciation you've taken on that asset. So I'm sitting here telling you to front load and take all as much depreciation as you can. And CPAs are like, well, that just means I have a bigger tax bill at the end. And the answer is no, and I'll tell you why. Let's say I buy a building for $1 million. I sell it 5 years later for $2 million. Okay, so it doubled in value over 5 years. When I go to settle up with the IRS, I'm telling them that everything's doubled in value. My land is doubled in value. My walls have doubled in value. My roof is doubled in value. And guess what, IRS? So is my dirty, nasty carpet that's 5 years old and stained. Mm-hmm. Why are we selling our dirty, nasty carpet for more or double what we bought it for? The IRS says carpet is a 5-year asset. So what is my carpet's book value after owning it for 5 years? Zero. It's fully depreciated. I've owned my 5-year asset for 5 years, which means it's fully depreciated and it's worth zero. But when you don't do a cost seg study and you have everything grouped together, I bought all this stuff for $1 million. I'm now selling all this stuff for $2 million, and the IRS is charging you tax on that. What should happen is when you sell your asset for $2 million, you should allocate the sales price to the land, allocate the sales price to the building, but don't allocate the sales price to the carpet, because the carpet is not worth more today than what I bought it for. And by doing so, you're creating what we call a rate arbitrage, where you're taking your deduction, your depreciation deductions against your ordinary income, paying it back at a capital gains rate, and saving the spread. And sometimes that spread could be as high as 17%. So take the deductions against your ordinary income at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. And that's really how cost segregation benefits you when you're selling an asset.
That is awesome stuff. I'm excited to jump into these things and see where, I guess, these opportunities continue to go and grow for us real estate investors. Huge amount of information here, Erik. Man, I could just go on for hours and hours. I try to wrap these up quickly or in 30 minutes, but man, I could just keep talking and talking. But if anybody wants to learn more about Cost Segregation Authority, they can find you on the website, costsegauthory.com, costsegauthory.com for our listeners out there. And they can connect with you, right? So do you guys staff engineers? Do you do the full studies, or do you write the reports and do full studies if there's a requirement from the IRS, or how does that work with the cost seg?
Sure. So we're kind of a unique accounting firm where we just do cost seg. So we don't do tax returns at our firm. So we partner with your CPA. Your CPA doesn't have the knowledge or the bandwidth to do these cost seg studies themselves. And so they will typically outsource this work. So we partner with your CPAs, and we provide, our deliverable is about a 40 to 50 page report. Your CPA is probably going to skip the first 49 pages. They're only interested in that last revised depreciation schedule. They upload that into their tax software, and that's how you realize the gain. So they need us to identify what assets are in the building, what's the value of those assets, and then they take that information, upload it into their tax software, and that's how, again, you realize those deductions. So we work hand in hand with the CPA or the tax preparer.
And is there any kind of projected price, hypothetically speaking, if I own a $150,000 single family house, what would a cost seg analysis look like?
Sure. So kind of the costs on these, it's based on the size and scope of the project. Unfortunately, the IRS doesn't allow us to bill you based on what we can save you, because I'd probably be retired by now because we've saved so much money over the years. But we bill it on the size and scope of the project. So like a single family rental, you're probably $2,700 for a study. And we can do large, office complexes with multiple buildings for $20,000. So I know that's a wide range, but it just depends on the size and scope of the project. Most cost seg companies out there will provide a free benefit analysis before they ever engage you to do business. And so we just need a little bit of information like where the property is located, the address, the purchase price, the in-service date. From there, we'll run a quick analysis and to say, okay, conservatively, Brett, we can save you $80,000 on your taxes. It's going to cost you $4,000 for the study. And then you work with your tax preparer to decide if it makes sense or not to move forward this year. You want to use these deductions to offset income that's in those highest tax brackets. So let's say you had a down year, you didn't make a lot of money this year, but next year you anticipate selling your company or having a huge gain, that maybe we don't do the cost seg this year, we do it next year. But getting that analysis done up front is important so you have the information and the numbers, and then you work with your CPA to determine when is the right time to implement those deductions.
Awesome. And in all of the scenarios we put together, that cost is overshadowed drastically by the value that you received from Cost Segregation Authority. So all the listeners out there, again, that website is costsegaauthority.com. And I'm going to throw that up on our physicianwealthsystems.com resource section too. I absolutely love the idea of cost seg. I love sharing information that brings value, enables us to keep more of the money that we're making. Thank you for your time, Erik. You explained this stuff fabulously. I wish I had a better word for that, but man, it's so clear. And yeah, so helpful. And even the hand gestures that the listeners can't see, I relate to those again. So thank you again for your time today, Erik.
No, thank you, Brett. It's been a pleasure being here. And I'll just end by saying, please use this as a resource, you guys. We don't bill by the hour. If you guys have questions, my contact information is on that website. You can reach out to me, call me, say, hey, here's a situation. I'm thinking about buying this property. Is this a good one for depreciation? Can you run an analysis? We're happy to help answer any questions you guys might have. Again, we don't do tax returns, so don't ask me about earned business income or child tax credits because I don't know anything about that stuff. But anything about depreciation, please don't hesitate to reach out. We'd be happy to help you guys.
Sounds great. And to the listeners out there today, hopefully we've brought you some value. If this is something you're considering, if you're currently a real estate owner, or if you're looking at real estate in the near future, this strategy is really, really important. Go to the website, track down Erik's, grab a couple of minutes of his time. He's wonderful to talk to. And just thank you for your time again today. And thank you for your attention. If you have any questions for us, you can reach us at info@physicianwealthsystems.com. And find some more resources as well, too, on the website, physicianwealthsystems.com. Until next time, this is Real Estate Mogul, MD.